Well, hello and welcome to another episode of the Capital Record. And this is one I've been looking forward to for some time. I worked quite a bit to be able to secure this guest, and I think we're in for a big treat. So many of the guests we've had on Capital Record are really highly distinguished and wonderful people that I think it's a privilege to have. But with all candor and humility, they are people I know, or generally have been people that I've had a relationship with, and I'm just blessed to have great folks in my Rolodex in a lot of cases. But today's guest is not somebody that I have known or had a relationship with. And yet, upon reading some of his contributions to the subject of ESG and some of his incredibly thoughtful contributions in the face of controversy, I reached out to him. He's a renowned expert in the world of corporate finance. I've been reading some of his material in corporate finance for a long time. And I'll give you a little setup here, and then we'll get into the interview. But today's guest is Aswath Damodaran. He is the professor of finance at NYU Stern School of Business, and arguably one of the prominent names in corporate finance and investment management in the world of valuation. A renowned academic, his both MBA and PhD from UCLA's Anderson Business School, and just a multi-decade expert in the world of valuation and investment finance, who decided some time ago to look under the hood of ESG and do his own exploration as to whether or not they were delivering on the goods that they were promising. I want to have a discussion with Aswath today about those assertions that the ESG world has made and what he thinks about its contributions to our economy, about the risks that exist in corporate America as a result of this new craze. And I'll let you decide for yourself if he brings up some healthy and cogent criticisms in this time where perhaps healthy and cogent critique is exactly what's needed. So with that said, welcome to another Capital Record podcast, and welcome to another first-time guest, the highly distinguished professor from NYU, Aswath Damodaran. Professor, welcome to the Capital Record.
Glad to be on.
I have been reading much of your work, and I imagine many of our listeners, for some time in the field of valuation and in corporate finance, in risk asset valuation. And I think you're well known for your expertise in that area, certainly what you teach academically. And yet our interest today, and what a lot of people have been thinking about, talking about, writing about over, let's say, the last year or so, are some of the public pieces you've published skeptical of the ESG movement and its ability to deliver on some of what it's promised. And it's a subject of great interest to us here at National Review. And I'd be curious if you could just summarize some of your recent public teachings and thoughts on the subject.
I think that let's start with the fundamentals. I mean, you said the ESG movement's promises, and I think therein lies the first part of the problem. First, even among those people who are ESG advocates, there seems to be no consensus in what exactly ESG is trying to measure. I mean, some in the group claim that it's trying to measure virtue. Some in the group claim that it's trying to measure risk. But if you can't make up your mind on what you're trying to measure, what your end game is, it becomes very difficult to actually have a debate with a group of people who are disagreeing among themselves about what their basic objective is, what they're trying to measure. So that's my first issue. The second is the promises are what drew me to this topic in the first place, because it struck me as having your cake without calories. Now, basically, you can have everything good and you have to sacrifice nothing for it. So what drew me first to the topic was this notion that ESG advocates had, that they were going to companies and saying, you can be good and be more valuable. They're telling investors, you can be good and earn a higher return. And in at least my experience, that's not the way things work. I mean, through history, being good has always meant sacrifices, giving up something. So the fact that they were selling me on this notion that I could be good and come better off at the same time, become better off at the same time, struck me as a false promise. And that's what led me to take a closer look at, hey, what are you selling? What are you basing this argument on? And the more I look at it, the less I think about the concept.
And so the analogy seems quite a helpful one. I wrote a book last year called There's No Free Lunch,
Mhm.
250 Economic Truths, obviously borrowing from Milton Friedman's nomenclature, about the notion of markets and our activities in markets, the allocation of scarcity involving trade-offs.
Yeah.
Investors don't have a hard time generally, at least professional ones or thoughtful ones, mature ones, know that with greater reward comes greater risk. You're applying that concept to the ESG world, that they're attempting to claim a sort of calorie free ice cream where you can lever up on virtue and yet not take any kind of hit to performance or some other aspect of the portfolio. Is your general criticism theoretical? That theoretically we know that to gain something, we usually have a corresponding trade off? Or is there something more practical at play with ESG that drew your attention?
No, it starts with that skepticism, which is, I mean, the way I describe it is in a mathematical construct, which is if you have an optimization problem, putting a constraint on an optimization problem can never yield a solution better than the unconstrained optimal. A constrained optimal can never, and in a sense, that's what ESG is offering, a constrained optimal that somehow beats an unconstrained optimal. So you have 500 stocks in the market, you take 50 out and you pick among the 450. There is no mathematical way you can prove to me that picking out a 450 rather than 500 yields a result better than looking at all 500. So it started with that skepticism. So I started to look at the evidence that they claim to use to back their own claims. So there's a whole set. I mean, I get Google alerts me every time there's a paper in ESG, and I just do it for curiosity. I take a look at these papers. There are about 3 a day being written now by academics. And I am horrified by the quality of research that passes for ESG research. To me, it seems like, we know the first rule in statistics is if you bring a significant amount of bias into the process, you're going to find whatever you sought to find in the first place. And to me, a lot of the ESG research that I look at reflects the view of advocates rather than researchers. People are convinced that they're doing good and therefore are trying to use the data to advance that view rather than taking a look at the data and say, does this actually make sense? So what I actually did was I took each piece of the promise that they made, which is they go to companies, you can become more profitable. I looked at the research and asked the question, well, what can explain what we can see in the numbers? And as I looked at each piece of the research, what I found was there was another much better explanation for what you were seeing in the research than ESG contributing to those additional profits or returns. So it started with skepticism, but the more I look at the data, the more I'm convinced that the data doesn't back them. And the last 2 years, I think, have been a wake up call to those people who used a decade of data to advance those promises and discovering that that game is not endless.
So let me guess as to what that data you saw showed, and you tell me where I need correction. I guess that after the theoretical, when you graduated to an evaluation of the empirical, you saw that what ESG advocates were claiming was outperformance was really sector attribution, that energy had lagged and technology had led. And lo and behold, the last 2 years that is reversed. How did I do?
That's a first. The other is they miss the causality question, which is, and what I mean by that is they found, for instance, that good companies have higher ESG scores, and they concluded that that must mean that having high ESG scores made you a good company. I would suggest a reverse hypothesis. is a much more credible one, which is if you're a good company, you're doing well, you're then able to check off all the boxes that Sustainalytics or S&P or whoever else is requiring that you check off to have a high ESG score because you have the resources to do it. There's actually research that shows that larger companies have higher ESG scores than smaller companies. Maybe there's some universe where you can argue that larger companies are more virtuous than smaller companies. But I don't believe that universe exists. That suggests to me that you've created a system that's being gamed where larger companies with more resources are able to play your game better than smaller companies without those resources. So I would argue that what you might be finding might actually be the reverse causality. Companies that are more profitable are able to play the ESG game better than companies that are less profitable. We know how to get around this in research. And the surprising thing is ESG researchers don't seem to want to ask that question. The easy way to show that ESG delivers higher performance is rather than look at the correlation between ESG scores and performance, you got to look at the correlation between changes in ESG scores and future performance. In other words, if you can show me that companies that improve their ESG scores become more profitable in the future, have higher returns, then I'm willing to listen. But showing me that there's a relationship between ESG scores and performance, which is contemporaneous, shows me absolutely nothing. You're violating one of the first rules in statistics. And in finance research, we know that this would never pass muster, but somehow, because you got an ESG in the name of your paper, people seem to be willing to look the other way.
Well, I think it's fascinating how obvious it seems when you explain it that way, that if we were talking about any other demonstration of statistical relationship, this would be non-controversial. And particularly in investment finance, these are rules and principles and formulas that we're well aware of and that we utilize to test correlations in other elements. And yet it does seem that there's been a pass granted in ESG. Is your conclusion that that pass it has gotten is ideological, that there is a sort of movement that has enabled it, or do you think it's more marketing driven, that Wall Street has tapped into something that people want to buy? There's a kind of virtue signaling component. Where do you believe this comes from?
I think it draws on a part of human nature, which is we all want to be good. We all want to be virtuous. And whenever we're presented a way of being virtuous and good, it's lent without sacrifice. That's basically what it is, right? Basically, you can have all the good stuff that comes from virtue without any of the sacrifices. It's an easy sell. And once you make it about virtue, it becomes very difficult to push back. One reason I think ESG got a free pass is people were not willing to push back because they were afraid of being labeled as bad people. How can you push back against virtue? How can you push back against goodness? And I think that that allowed ESG. In fact, I think ESG would have been better served if right from the beginning there had been a strong pushback that would have led them to reassess both what they're measuring with ESG and their promises. By giving themselves a free pass of 10 years, pretty much without pushback, they developed a discipline without a core. I describe ESG as trying to nail jello to a wall. There's nothing there. You try to nail the concept down. It's almost a shifting concept because for 10 years they got away without having to clarify what exactly they meant by ESG. I think the Tesla S&P ESG fiasco kind of brings out every conceivable weakness in ESG. And as your listeners are aware, the S&P ESG index removed Tesla from its ranks, arguing that was not good enough. And of course, the first reaction you got from Elon Musk reflected Elon Musk's typical reaction, which is he called ESG a scam. But I took a look at what the head of S&P's ESG group wrote in defense of why they took Tesla out, and I think that defense is actually the strongest argument you can make against ESG. First, she said that the reason Tesla had dropped out was not because their score had dropped, but because everybody else's score had gone up. already you're telling me that this is basically a gaming system then. It's not like companies became more virtuous over a year and a half or two. They've learned to game the system where they see the check boxes you want and they're basically checking them off and their score is improving. Tesla refused to play the game and maybe that's why they were punished. The second is she said, look, ESG is not about just climate change, it's about social issues as well. No, because for the bulk of ESG's life, it's lived on climate change. That's basically been its driving force for good and bad companies. And of course, that's not working anymore for a simple empirical reason. The best performing sector over the last 2 years is old fashioned fossil fuels. So it's almost like they're looking to, hey, let's redefine ESG. And her argument is ESG is much broader than just climate change. Tesla doesn't treat its employees well, to which my counter is, I would love to see, get a group of 10 Tesla employees and 10 GM employees into a room and find out how many of each group would go over to the other group. In other words, how many Tesla employees would switch their jobs to go work for GM and how many GM employees would switch and work for Tesla. Because if you're so convinced that Tesla mistreats its employees, it should be a slam dunk. Every Tesla employee should want. I would be hard pressed to find an experiment like that that would work. But I think the minute she brought in the social issues, she now opens up ESG to this very real question of who gets to define what's socially good and bad. I mean, this is the problem with the virtue part of it is, let's face it, virtue-based investing predates ESG. You might have heard of the Anno Domini Fund, which is for religious Catholics, where you invest in companies that don't violate Catholic constructs. Islamic finance is as old as the religion itself, where you don't invest. If you're a religious Muslim, you invest based on Islamic finance. I understand those because they're very clear. This is based on religion, good and bad. But if you're not religious, which is what S&P obviously is not drawing a religion, then who gets to decide what's good and bad? I mean, what made you the arbiters of this decision? The level of sanctimony and arrogance in an entity claiming to say, we'll tell you what's good and what's bad, strikes me as at the core of why ESG is in the straits that it's in. Now, I challenge people who say, let's focus on the S part of ESG to name me one social factor where you're going to get consensus across people. Almost every social factor you pick, I'll wager you're going to split 50-50 down the middle. For every half that thinks this is a great thing, there's another half that says, hey, this is not what I wanted. So how does S&P decide good or bad once you bring the S into the equation? So I find it amusing when ESG advocates complain that this has become political. This is the big thing in the last few months. It's become political. The red states are pushing back. ESG advocates complaining about ESG becoming political are like pyromaniacs complaining about the fires around them.
Yeah.
Hey, you started the fire. Get ready to live with the heat. You brought the S into the equation. Now the S is obviously going to get you backlash. Don't complain about it because this is what we were trying to avoid when we said, let stockholders and investors make their own social decisions. It's a personal decision. You can't centralize it. You chose to override that and say, we're going to centralize the measurement of virtue. Welcome to the blowback.
The National Review cruise is back this November. You can join us for a very special vacation. The National Review Institute is continuing National Review's 20-year tradition of memorable cruises, setting sail for 7 days in the Caribbean aboard the luxurious all-new Sky Princess. Enjoy fine dining, entertainment, and world-class accommodations as you rub elbows with NR personalities and other special guests during panel discussions, breakout sessions, exclusive 1955 society events, and more. Destinations include the Bahamas, Puerto Rico, and the Dominican Republic. To register, visit nricruise.com. That's nricruise.com. Please check it out.
And so let me ask you a question, because I agree 100% with what you're saying, and the way you're framing the argument, I think, is vitally important. But I'm not sure that the point you're making is limited to the S. I would think there's some subjectivity in both the E and the G as
Absolutely.
well. and that even within environmental objectives, there is and should be some debate about nuclear versus non-nuclear advocacy for those on the side of decarbonization. Even for someone like myself who wants to see lower carbon emission but is generally pro fossil, I see natural gas as a tool towards that aim, where others on the E side of things believe natty gas is to be as morally repugnant as coal is. And then the G side is particularly flabbergasting to me because the number one holding in the BlackRock ESG ETF is Facebook, where Mark Zuckerberg gets 100 votes for every one vote his shareholders get. And I'm not sure what standard of governance that is considered to be appropriate in. And so, isn't that subjectivity argument you make problematic for all three of the alphabet soup of this?
Absolutely. Let me start with the G part. I've never understood why G made it into ESG because I've been in corporate governance now for 40 years. This predates ESG. Corporate governance is making managers accountable to shareholders. That's not the G in the ESG. It's false advertising. The G in the ESG has nothing to do with governance by shareholders. It's CEOs have to be accountable to society. In fact, when I half jokingly said the reason ESG includes G is for the same reason East Germany used to call itself the German Democratic Republic. There was nothing democratic about East Germany, but they called themselves the GDR because it created this illusion that there was something democratic about the experiment. ESG has never been about corporate governance. It's been never about managers being accountable to shareholders. It's about making managers accountable to everybody but the shareholders, accountable to society, accountable to basically every stakeholder group. In fact, there's this whole notion of stakeholder wealth maximization, which is one of the stupidest concepts I've ever heard. It was born in a law school, so that might explain it. Because lawyers love stakeholder wealth maximization because it means that every stakeholder can sue every other stakeholder, and you now have additional business as a lawyer. So the G part has never made sense to me. It doesn't even belong. It's got nothing to do with corporate governance. Maybe the G has to be called something else. But let's take the E part. It's true that there's some degree of consensus that there's climate change, that we're facing climate change, that we have to do something. That's where the consensus ends. Here's the problem with the ESG group pushing the E part as something that companies need to adopt voluntarily, which is basically what they're saying. They say you should be, it's not just what the law is, but you got to go well beyond that. You got to go for net zero, even if that's not the rule. The problem with doing this selectively is you might accomplish exactly what you set out to accomplish at the companies you've targeted, but the larger problem is actually made worse by what you've done. Let me explain. One of the pushbacks I get from ESG advocates when I talk about ESG is, it's true it doesn't help companies. It's true shareholders might not make much money, but it still makes society a better place. I said, really? By doing what? They give me examples like Engine One's pressure at ExxonMobil, where Engine One managed to get ExxonMobil to divest itself of some of its fossil fuel reserves. The key word is divest itself. When you divest it yourself, somebody's buying those reserves. And guess who's buying those reserves? In the last decade, private equity investors have invested more than $1.2 trillion in those fossil fuel reserves. All you've done is shifted those reserves and production from the hands of companies where you might have at least a chance of putting some pressure on the companies to be good custodians of those reserves into the hands of private equity investors who feel no qualms about listening to you. We've taken fossil fuel reserves and actually moved them from people who might be decent custodians of those reserves to perhaps the least scrupulous people on the face of the earth who have no accountability at all. There's a reason why 12 years into ESG, 80% of our energy still comes from fossil fuels. If ESG is working so well, shouldn't we be like 60%? There's been almost no change. So effectively, what you're getting is this cover of look at how much good we're doing, when in fact, all we're doing is pushing the bad stuff behind the curtain, where private equity and privately owned companies can do the damage. And we're not looking. It's because we're not looking, it's not happening. So in a strange way, I think ESG has actually made society worse off rather than better off by taking the worst practices and pushing them behind the curtain.
Is it true that ESG's failure over 12 years to deliver on greater use of renewables as a percentage of total energy consumption, is it also true that there's a failure of renewables to become a more viable and profitable investment selection?
I mean, let's face it, solar and wind will never be enough of an energy source to cover our energy needs. Right? There's not, I mean, partly because we're dependent on nature, and nature can give only so much. So it's always been true that if you're talking about alternative energy, it has to come from something other than the classic green energy sources, which is the nuclear power. So as long as you made nuclear power part of bad, which is for a long time the ESG view, then, and you also said fossil fuels are bad, what exactly did you expect to see as the outcome from pushing companies to have less of a carbon footprint? Because ultimately people need energy. They're going to use the energy. And if you're not creating other sources of energy that are large enough to make up for fossil fuel energy being withdrawn, fossil fuels are going to continue to be used. So I think it's again a reflection of those subjective choices that were made early on what, I mean, let's face it, ESG was born out of a United Nations, I think it was UNCTAD document. I can't think of very many good things that have been born out of a United Nations document. So the very fact that its birthplace is a UN document makes me a little suspicious about where the end game is. But I think, in a sense, ESG is so totally confused that at this point, I don't even plan to write about it because its own internal contradictions are ripping it apart so much that I'm just going to sit back, get some popcorn, and watch the ESG advocates go at each other. Because you're going to see the contradictions come to the surface and they're going to show up in decisions that other ESG people are considering. Really?
Is that becoming more clear to people that maybe are a little less partisan, a little less um, politicized in this? Just your sort of quintessential independent, moderate type observer. Um, are some of these internal contradictions becoming more clear? I think too the idea that we have said we demand U.S. energy companies produce less, and we try to starve off capital from getting to them, and yet right now the big plea is for foreign countries to pick up the slack. We need OPEC doing more production. Is the idea, and this is very analogous to what you said about Exxon having to divest of a particular fossil investment, that all they're doing is moving it from their hands to someone else. I don't believe that there is a better result for the planet in Saudi Arabia doing production that we won't let Oklahoma do.
Yeah.
Is this becoming more clear? And is this churn in markets whereby some of the quote unquote ESG space has underperformed and some of the fossil space has outperformed? Is that the catalyst? Or do you think there's just people like yourself making a kind of common sense argument that's starting to catch on?
I think it starts slowly. Part of the reason is there's too much money at play in ESG. Too many
Yeah.
people have, I mean, I call this a gravy train for a good reason. There are multiple entities making money in ESG, starting with the Morning Stars, the S&Ps, the measuring services, the investment funds like BlackRock that mark up their ESG funds by delivering three times more fees than on the non-ESG funds. Consulting firms. I read an article in McKinsey today about how ESG increases value, the emptiest article that I've ever read. And in a sense, I've given talks to the CFA, and the CFA now is this ESG certification, something I find almost horrifically ill thought through. But I think a lot of people are making money in ESG, which means that there will be a vested interest to keep it going, to keep redefining it. I'll be a cynic. I'll argue ESG is not going to go away. It's always been there. It used to be called SRI and CSR, and it's had multiple versions. It'll get a different name. And I'll suggest one name that you're probably going to see is sustainability, another kind of diffuse word that could mean everything or it could mean nothing. That's almost impossible to push back against. Who wants to argue against sustainability? It's like apple pie and baseball. I mean, things you take as good and you want to kind of keep going. So I think that you're going to see it kind of remorph into something else. And trust me, there'll be an entire body of evidence then backing up that that particular buzzword will deliver higher value for companies and higher return for investors. So the cynical part of me knows that this is always part of the game. You know, I think the good news is that I gave a talk to a bunch of directors at some of the largest S&P largest companies in the U.S. A couple of weeks ago, and one of the things they were asking about was, hey, we get a lot of pressure on ESG, and I gave them a template of questions to ask. I said, don't push back against ESG. When that ESG service comes in and says, you have to do this, this, and this to come up with a higher score, ask them, what exactly are you measuring with ESG? What is it that you're trying to measure? Are you measuring goodness? Are you measuring risk? If they say they're measuring goodness, then say, is it whose measure of goodness? So push back on the goodness. If it's risk, then they're stuck, because if it's risk, then the question is, if it's risk that I might default on my debt, why aren't your bond ratings carrying it? Why, if you're S&P, do I need a rating for ESG if you have a bond rating that's supposed to measure default risk? Push them on the measures, and you're going to very quickly see that they have no idea what they're measuring. That's a dangerous place to be, to come up with a score with 100 different things they're asking you to deliver when they have no idea what they're trying to measure. When the consultant walks in and says, if you do this, you'll become more valuable. Ask them how. What's going to happen? Am I going to grow faster? Am I going to get more profitable? You're asking me to spend $100 million on getting better source coffee. Okay, I'm willing to listen, but tell me how spending $100 million more on better source coffee helps me if I'm Dunkin' Donuts and the guy who walks in to get a coffee has absolutely no interest in where I source my coffee. He just wants to know why the price of my coffee went from $1.50 to $2. So push them on details, because there are no details here. They've been able to skate on the surface by just selling you the big story, when in fact there's very little tangible evidence to back them up. So I think the questioning is where this is going to begin. And when the questioning gets tough, I'm going to argue that these consultants and services absolutely have nothing to fall back on. They have really no basis for what they're doing. So when they start to get questioned, you're going to very quickly start to see them withdraw from the ranks, because they can't really take being questioned. There'll be a subset of companies still that invest in ESG for the same reason they spend money on advertising. They just think of it as good housekeeping. But I think the less people value the ESG stamp, in fact, you probably read that the EU recently did, in fact, the sensible thing, which is they said, hey, you know what? Your nuclear energy is good energy. But the kind of blowback they're getting from ESG is exactly the kind of internal fights you're going to see in ESG, because they really haven't made up their mind on what exactly they're trying to measure and why it delivers value to investors and companies.
Well, just as your initial skepticism came from the belief that there are trade-offs, and somebody presenting something as lacking a trade-off, that you could both be good and not pay for it, that principle is sort of a basic approach to economics that I take and that I was taught economics with. Another pretty basic entry into economics is the belief in incentives. And I think I was a managing director at Morgan Stanley when much of the ESG craze was beginning. And it was very clear to me that it was moving through their ranks no differently than any other en vogue asset management strategy would. Something not but much different than how BRIC in emerging markets became a marketable concept, and how private equity became such, and how hedging the different seasons of times in markets produce, generally, by the way, it's a lagging indicator, as you well know. But it seemed to me that ESG at Morgan was just sort of working its way through the marketing machine.
Mm-hmm.
The incentives, when you talk about Fortune 500 CEOs or their various personnel pushing back or asking questions, are the incentives there for this to actually change, for there to
What'll
be
make
a
the
pivot?
incentives come back is we have a recession. In good times, You have excess and surplus at companies. You can afford to be sloppy and get away with it because you can hide your costs under the fact that revenues are growing 8%. Now, I think it sounds callous to say that sometimes you need recessions and market cool downs to get excesses out of the system. But it's been true. And I think, in a sense, one of the things that might come from a market cool down is CEOs will now have to start asking questions because they have no choice. They have no cover for spending the extra $150 million with no really good reasons. So in a strange way, I think a recession and a market cool down might be exactly the kind of medication that the fevered masses need to kind of come back to earth and say, hey, what are we paying all this money for? Other than to make McKinsey wealthy and Sustainalytics look good, what exactly have we accomplished after 12 years of ESG? So I think that's what's going to cause some of the questioning to begin is companies, if they don't have the slack, are going to be much more reluctant to spend the money that ESG advocates are asking them to spend without some sense of, hey, why are we doing this? What's the payoff from doing this? And airy statements about how you will see in the future is not going to be enough when you're feeling pressured on the financial front.
Well, it's a wonderful point, and it's great, thoughtful consideration on this topic. I honestly can't thank you enough for the conversation. I've learned a great deal from it. I know our listeners will as well. I appreciate your organized thoughts and high conviction on such an important topic, and really, in a lot of ways, kind of a contrarian one for an esteemed member of the Academy. I think you're taking a bold view, and I appreciate your insights a great deal. So thank you very much. I hope you will join us again.
You're welcome. Thank you.
Well, I honestly don't even know what to say right now. I enjoyed that 30 or 40 minutes as much as I've enjoyed any conversation since we started Capital Record. He is clearly very sober-minded, thoughtful. I think that there's a really amazing non-ideological, non-emotional frustration he has with something that deserves our frustration. This ESG world lacks foundation, it lacks clarity, it lacks rules of the road, and it is producing a counterproductive effect to what they are marketing. It is taking money from the economy. It is benefiting the large at the expense of the small, and with no discernible benefit. I don't know how you could offer a more decimating critique than that. All the way through, I agreed with his analysis, appreciated his perspective. I hope you learned a lot about it. The key 3, 4, or 5 bullet points necessary to put a dagger through the heart of this ESG cult. What a fantastic contribution from a highly renowned financier, academic, and financial intellectual. We will do our best to have him back on the podcast. In the meantime, please share this far and wide. This message, more than any other I can think of right now, is one I'd love for you to send as people continue to feel good about the virtue that they invite by saying they are ESG oriented. Send them this podcast to rethink the folly of their ways. And thank you, of course, for listening to Capital Record, and thank you for joining our cause of a free and virtuous society.